Good morning. Welcome to the final installment of Burning Questions with the CIO for 2025. My name is Nirdev Desai, and I'm looking forward to the next 30 minutes with PSG Asset Management Chief Investment Officer John Gilchrist, who is going to be chatting with me through all the questions that you've posed through our webinar today. While we endeavor to answer all the questions that have been shared, we want to also make sure that we give holistic but also as specific answers as possible. So thank you very much for everyone that has shared them. And while we try to make sure that we are as specific as possible, we want to make sure that the answers are not short-term reactive. And so we want to make sure that the answers are good for sustainable long-term returns. And so, without further ado, let's get cracking. Morning, John. How are you doing?
Morning, Nirdev. Doing really well, and thanks for everybody that's signed in today.
We've had a good couple of questions, so I'm going to be doing it in a bit of a thematic approach in terms of ranking the questions together. So the first question on everyone's mind is about gold. So how are you viewing gold in the portfolio currently? And specifically, Johan van Niekerk's question, gold prices are high. Why are they as high as they are right now? And what are the risks to the downside? And should one consider them still a long-term play in portfolios?
Yeah, great question, Nirdev. Those of you that know PSG Asset Management will know that we've been positively disposed towards gold for quite a period of time. We actually bought Wheaton Precious Metals back in 2018. That's a royalty company streaming both gold and silver. And then in April 2020, we bought Anglo Gold as well. And then towards the latter part of 2023, early 2024, we did a lot of research into gold and gold shares. And as a result, on the back of that research, we increased our exposure quite substantially. And then in October 2024, we put out an article talking about the fact that we viewed that gold was in a secular bull market and pointing out that from a global perspective, the likes of Barrick and Newmont, the gold majors, were chronically underowned. And that was a real setup, we believed, for great performance from those shares and from gold generally. When we look at gold in our portfolios, and when I talk about gold, both the physical metal in the form of an ETF, as well as the gold shares, we really look at it as both defensive and offensive. So firstly, on the defensive side, gold has a long-term low correlation with other assets and asset classes. But more importantly, it tends to outperform, and sometimes quite significantly outperform, in periods of high geopolitical tension, during periods of fiscal and monetary stress. So those characteristics are well known and are part of why gold can be a real additive from a portfolio construction perspective. But what really got us excited was the offensive nature, the alpha potential from gold and gold shares that we saw. And that really goes back to, in particular, 2022. We saw the weaponization of the US dollar and US treasuries following Russia's invasion of Ukraine. And as a result, we saw a step change in central bank buying of gold. And that created a real underpin to the gold price. In addition, our view was that the environment would be one, from a macro perspective, very supportive of gold. We saw inflationary pressures. We saw constraints around in particular, the Fed's ability to react to those pressures. And that's a fantastic environment for the gold price. So gold, we looked at it, we said, this is an area we want to be invested in, both from a portfolio characteristics as well as an alpha generating perspective. In the research that we did back in January 2024, we had $4,500 as our bull case scenario for gold. And despite that, we were pretty surprised how quickly and aggressively the gold price moved, and in particular from that period of mid-August through to mid-October. Ultimately, if you have a look at it, and referring to this slide over here, which is the World Gold Council data looking at rolling 12-month demand for gold, what's interesting is the blue line over there, you can see the big uptick, that's central bank buying of gold on a 12-month rolling basis. You can see the move up in 2022 and then stability from then on. You can see the yellow line being jewelry demand actually declining as the price went up. And then very importantly, what we saw was the gold price moving up on the back of central bank buying, causing an increase in investment demand. And some of that would be genuine investment demand. Some of it would be more speculative in nature and possibly retail. And that drove the gold price up further, which then attracted more investment. And so that move that we saw in August through to October really felt like it was froth. And as a result, we took the opportunity to trim some of our gold holdings in certain of our portfolios. What was interesting, especially in early October, you saw that what looked like a number of our competitors clearly behind in terms of their weight to gold. And remember, by the end of September, within the capped SWIX all-share index, gold miners had become 16% of the index. So those that were behind were having to catch up and chase this price that was moving higher. And we saw a lot of industrials and financial shares being sold off and the precious metal shares moving up. So an interesting environment. If we stand now, we look at it in terms of the gold price just above $4,100. Some of that froth has clearly come out of the market. We believe that gold and gold shares has once again shown its credibility in terms of being a diversifier. The gold shares themselves, as was evidence from Anglo Gold's results earlier today, they are not expensive. The earnings are still coming through, and they're actually pricing significantly lower gold prices than is currently being seen in the spot market. And we think the secular bull market is still intact. And so we are expecting further periods of the speculative froth, but overall that long-term thesis is intact.
Okay, great. So John, gold wasn't the only thing that shone over the last while. So let's take a question a bit broader across commodities in general. So in particular, we got questions from Herman Wheeler and Hubert Way. So thank you very much, guys, for these questions. Complementary to the case for gold, what is the long-term commodity case? Does it still have legs? And then the very important question is, how do you choose between the commodity and the miners that actually produce those commodities? Could you maybe expand on that as in terms of your views?
Certainly. So I think most investors in commodities and commodity shares, their starting point is the demand side. And commodity demand is very highly correlated with GDP, with the exception of certain periods like China's significant infrastructure build-out, which created additional demand. But broadly, it's going to be correlated with GDP. And as a result, it's seen as high beta, high risk. If there's a recession, commodity prices come under pressure. And as a result, it's quite a difficult investment for a lot of people to get their heads around. And forecasting demand is incredibly difficult. We find it much more useful to focus on the supply side. And if you think about commodity producers, you know the lead time to start a new mine, to expand on a mine. You know exactly how much capex is required. A lot of that capex will be in the public domain. And so you can actually forecast supply for a lot of commodities really, really well. And then if you sit back and you have your supply forecasts and you take very conservative views on the demand forecast, and there is still a shortfall, that is a very, very strong signal for us that there is great support for the underlying price. And that's what we've done. That's how we've looked at commodities. It doesn't always help you with the timing, but it generally gets you right from a directional perspective. And probably a great example of that is our exposure to platinum counters. So if you have a look at platinum, and so there we have the platinum price in dollars year to date, platinum up roughly up 73%. And then we have Northern Platinum in rands. And remember, the dollar price, the rand price would actually be lower than the dollar price given the strength of the rand relative to the dollar year to date. And that's up about 176% year to date. So essentially, when you go into the underlying shares, you're getting a geared exposure to the platinum price. We were positive from a supply perspective on platinum, and hence most of our exposure was in the likes of Northern Platinum as well as Volterra. Going back in terms of platinum story itself, we could see obviously a lot of the platinum globally comes out of South Africa. We knew that supply was reducing in that area. A lot of the negative view on platinum was around the adoption of EVs, electronic vehicles. We thought that was overly optimistic, but that wasn't our core thesis. The fact that EV demand has actually is looking like lower than was being projected has been a boost, but the main thing is the supply shortfall around platinum. And as a result, we've had exceptional returns for our clients. We were probably a little bit early in the thesis, but as I said before, this doesn't necessarily help you with timing. You've got to have a longer term view to be able to invest on a supply-based thesis. So it's been a great delivered excellent returns for our clients within our portfolios. If we look right now and we say what other commodities look poised to us to benefit from a supply-based thesis, Copper looks interesting. Thermal coal and met coal both look interesting. And we are positioned accordingly and would expect a similar type of outcome in due course.
Great. And then talking about gold rush, AI is arguably the next rush that is on everyone's mind. So could you maybe share some insights? Specifically, we had a question from Samantha Herman and a couple of other anonymous respondents. So if I summarize the questions, what concerns you about the hype on AI? And through all this concern, are there any opportunities that you are looking to take advantage of through that investment thesis, that clearly there will be some winners, but possibly quite a couple of losers?
Yeah, so maybe before I get into the details of it, just to step back and look at the context is there's no doubt that AI is going to materially change business and change society. Even if artificial general intelligence is further away than is currently anticipated, I think the numerous use cases, and we're all seeing it in our day-to-day lives, it is going to make a massive difference. But there was some work done by a Nobel laureate, William Nordhaus, back in 2004. He published some work, and he looked at the US markets from 1948 through to 2001, and he looked at innovations. And he looked how much of the surplus associated with innovations actually ultimately went to the innovators versus society as a whole. And the outcomes were quite stunning. Per his research, 2.2% of the surplus went to the innovators and nearly 98% went to society as a whole. And that's exactly the problem that we face with AI, is it's clearly going to make a huge difference, but actually picking the winners and picking the investments that are going to benefit is incredibly hard. Ultimately, if you think about what you need to do in order to get the investment right, firstly, you've got to pick the winner. And that's not that clear cut. Given the scale of the CapEx, not everybody's going to be a winner in this space. That's not how capitalism works. There will be winners and losers. So you've got to pick the winner. That company that wins has to do so in significant size to justify the CapEx spend that is going in right now. So they have to generate significant revenues at really good margins and deliver the appropriate return on invested capital to make it worth their while. And then even if you get those two right, so you pick the winner and that winner does incredibly well, you've got to also not have overpaid for that. And the optimism baked into a number of the hyperscalers' share prices means that they could well win and still actually disappoint from an investment perspective. So that's what really makes it challenging to invest in this space. What makes it even harder is we've had these very, very complicated circular type of transactions associated with OpenAI. So I've put up a chart here that gives some indication. If anybody can actually fully understand the details of this and what is going on, I'd love them to give me a call, because to be honest, it's incredibly confusing and difficult to understand the economics associated with this. What we do know is that OpenAI has done about deals in terms of making sure they have data processing capacity, and those deals amount to about $1.5 trillion. As part of those deals, a number of companies have seen their market caps rise astronomically because of those deals that they've signed, most notably Oracle. And if you have a look take a step back and have a look, OpenAI is a company that it looks like it's going to generate about $12 billion of revenue this year. Obviously, that is moving up, but $12 billion for the year looks reasonable. And if you look through various different data sources, it looks like their last quarter, they lost $12 billion. So this company has been able to sign deals to the value of more than 5% of US GDP with credibility, despite significant losses. So that for us is pretty interesting, that's underpinning a number of share prices and market cap moves. And then when you have a look more broadly, one of the reasons that a lot of people say, this is totally different to the dot-com bubble is the very highly profitable nature of the hyperscalers and the significant cash that they're generating. And that is true. These are incredible businesses, very, very profitable, generating massive amounts of cash flow, but it's not infinite. And the amounts being spent on CapEx are becoming very, very large, associated with data centers and rolling out the AI infrastructure. And if you have a look, this is going back to 2012, and it's the CapEx share of operating cash flow for hyperscalers. You can see that significant move up since early 2024. and they're now spending 60% of their free cash flow on CapEx. And as a result, we're now seeing extended use of debt coming in over the last 6 weeks. I think there's about 100 billion of debt that has been issued associated with AI rollout across Meta, Google, and Alphabet, and Oracle. So they are turning to debt. And as a result, and as Kevin Cousins points out in an Angles and Perspectives that I think we're going to release early next week, yeah, he points out that there's a lot of parallels, once again, between the dot-com bubble and what we're seeing with AI right now. So a number of companies, a number of telcos built out the fiber that ultimately was the infrastructure behind the internet. In 2000, those companies spent about 1.2% of GDP on that CapEx rollout. Next year, the spend on AI is expected to be about 1.4% of GDP. So very similar type of spend, but it's really interesting to see what happened with those companies. So if we have a look at 3 of the biggest telcos rolling out that fiber, Vodafone reached 13% of the FTSE 100 index. Nokia reached 70% of the Helsinki index, and Nortel reached 36% of the Toronto index. So they became huge components within their respective indices. Subsequently, even though the fiber that they rolled out was absolutely crucial for the internet, Vodafone's market cap down 92%, Nokia's market cap down 91%, and Nortel down 100%. So it just shows how difficult it is to pick the winners, even though we know AI is going to materially change the world. Picking the right investments is very, very hard.
So are there winners that you're going to be looking forward to picking?
So we don't just sit back and say, well, that's uninvestable. We're constantly looking at it. So earlier this year, Alphabet, which is the listed name behind Google, the thesis was that the likes of ChatGPT was being used for search. Google search would be undermined by that. And so the share price came under a lot of pressure. We were able to buy that at about $162 based on research and our view that that was oversold, that it was too negative. We actually saw significant use cases and monetization opportunities for Google with AI. And subsequent to that, as of today, it's up about 80% since we bought it. So we don't just sit back and ignore the opportunities. We look for shares that will get through our 3M process, moat management, and really importantly in this area, margin of safety. And then we try to look a bit more creatively. And probably where I'm going to go is not where you anticipated me going in terms of answering this question. But essentially behind these data center rollouts and this AI infrastructure is a massive need for energy. And there are various different assessments of what this is going to mean, but one that I've seen that looks credible is that data center use of electricity in the US will move from 4% to 10% of total electricity demand, so a 6% increase. This is huge, and this is material in terms of the overall pricing associated with it. If we look at things slightly differently, OpenAI, the $1.5 trillion of spend for data processing, that is going to require about 30 gigawatts of power. Now, when it gets to things like gigawatts, they're kind of a bit theoretical. So let me put it in context. That's the equivalent of the usage of about 10 million US households. It's more than South Africa's total grid. And to really emphasize how big this is, it would fire Marty McFly back to the future 25 times. This is a significant increase.
Give us that crystal ball.
So there's a huge demand for energy coming through. At the moment, 40% of the data centers' electricity demands are met by natural gas. And we've got an investment in CNX Resources. It's a Appalachian-based natural gas play. Really interestingly, it also does mine methane capture. So it captures about 9.1 million tons of carbon from the mine methane capture, which more than offsets the emissions from their normal operations. So they're a natural gas play that is actually reducing carbon globally, which is a fantastic situation to be in, and very well positioned to benefit from this demand increase. But it's not purely about AI. There's also the likelihood of LNG, liquefied natural gas, exports from the US doubling, so it's well positioned for that. And then on a standalone basis, it's a clear 3M stock. Excellent management. They are have reduced their operational risk significantly. They are the lowest cost producer, and they have midstream assets. And they basically, with those reduction in operational risks and costs, they have turned themselves into a cash generating machine, and they use that cash to either reduce debt or buy back shares. And over the last couple of years that we've held them, they've reduced their share count by about 40%. So as a standalone thesis, really good, but when you combine it with AI, actually really exciting.
Great opportunities, John. So the next question collated mostly from Henry Fourie and Henry Fillion. So thank you guys for the question. Equity valuations, I often say that history doesn't repeat itself, but history does rhyme. So what can history teach us about navigating expensive markets, and how is PSG Asset Management ensuring that clients have protection with some sort of inevitable pushback that should come along the line?
Yeah, so I mean, there's a lot of talk right now about markets being frothy, about AI bubbles and that sort of thing. This chart over here probably gives some good context for that question. So this is going back over the last 20 years, and it's the consensus forward price earnings ratios of a number of different indices. You'll see the top line there is MAGMAN, which is Mag 7 X Tesla. The acronyms keep on changing. You've got to be on your toes here. So we can see that that is expensive from a price earnings basis. Obviously, if the earnings do come through, that will deflate that price earnings ratio over time. And then the S&P 500, we've looked at it lots of different ways. However you look at it, it looks expensive. And even the S&P, so-called 493, is not exactly cheap. When you get to Japan, Europe, broadly across emerging markets, they fairly valued relative to their own history on this basis, but certainly significantly cheaper than the US. And then interestingly, South Africa, the MSCI South Africa, looks very cheap both on a relative and absolute basis, although there is a little bit of a distortion there because of those earnings still coming through on the precious metal side of things. So valuations do look high. When we look at things, as you would expect, you know our philosophy, you know our approach. We like to look in uncrowded areas for mispriced quality, inherent quality that the rest of the market has missed. So it won't be surprising that we are underweight the US, but there's still selective opportunities that we're exploiting, like the CNX resources. And more recently, US healthcare is an area that has been performed torridly. The share prices have been under pressure, and we've done lots of work in that space and started to invest there. Then we've got various different opportunities that we're seeing in the UK, in Europe, and then across emerging markets as well. If you have a look overall at our portfolios, and this is having a look at global holdings, our top 15 global holdings, and what we've got there is the PE ratio for this year, and then the profit growth expected over the next 3 years. And you can see that our portfolios, and you would expect it from us given our 3M process, are significantly cheaper on a price earnings basis, even though our profit growth expected is only marginally slower than pretty optimistic views, we believe, on the MSCI World Index, which is dominated by those large so-called hyperscalers and the Mag 7. So we would expect in a pullback, and timing a pullback is just something we don't try to do. It's not our core competency, but we would expect, given these characteristics, that we would actually hold up quite nicely. And then we do have in our multi-asset portfolios, we do have derivative hedges in place so that if there is some sort of pullback, we will be protected.
Thanks, John. So moving from equity valuations, Herman Wheeler, Sanjeev Bana, thanks for the questions you've asked around EM and China specifically. So if I can summarize the questions that we've received, John, is emerging markets an opportunity set that you're looking at? Maybe talk to it as a global investor through the lens of the PSG Global Equity Fund, and then also as a South African investor and maybe, our local fund range.
Certainly. So, I mean, if we rewind back to December last year and January this year, I was out doing the Outlook, and all the talk was about US exceptionalism. I think at the time, the US accounted for 73% of the MSCI World Index, and the surveys indicated that most global investors were overweight, so probably running 80% in US. And that narrative about US exceptionalism was totally entrenched. We questioned that, and we said it looked like it was overdone, and especially from a pricing perspective, we raised concerns. What's really interesting is people focus on AI and what's happened there. But if you have a look, and this is year to date, to the end of October returns across a number of different countries in dollars. And you can see there what we didn't expect is that even if there was a marginal shift of cash from the US into some of these other markets, because of the size of the markets, this could have a significant impact on the returns. And if we have a look there, people would be surprised. South Africa up 54% in dollars, Mexico up 45, Brazil up 41, China up 32. And so emerging markets have done very, very well. The US, the S&P 500, only up 18 year to date. So we have seen really, really good performance out of the emerging markets. You know, probably what is absolutely key for us is that, let's give a clear example in terms of how we look at EM investing. So back in 2024, we started to have a look at Brazil, initially from an investment that we were looking at in Petrobras. And as part of that investment, we needed to understand the economy and the politics within Brazil. And the more we looked at it, the more we got interested. And we look in areas that are uncrowded, out of favor. And so we sent a multidisciplinary team to Brazil, to Sao Paulo in early December 2024 to attend a conference and really get boots on the ground and start to understand that. And a lot of the time, it's just about actually forcing one to do the proper research with a deadline and to really focus in on that. So we went there, and then in December, through the course of December, the sentiment towards Brazil soured significantly. The asset prices sold off, the currency sold off, and given the work we had done, we were in a great position to step in and actually buy into that weakness, which is exactly the position you want to be in. We were able to get Brazilian bonds at 10% real. And so just to put that in context, the Brazilian 10-year bond yield was at 15.3. That's now moved down to 13.65 as of close yesterday. And at the same time, the Brazilian real has actually strengthened 17% against the dollar. So you can understand a really, really good return.
Proper double whammy.
For our clients from that investment. Your question in terms of looking at it from a global and a local perspective. So within our multi-asset funds, we actually funded a lot of that out of SA bond exposure. So we were able to diversify across that. So that's a differentiation in how we look at it. When it comes to China, it's clearly for a lot of people has become uninvestable. There's been obviously the way it dealt with COVID, then the way that from a political perspective, there were crackdowns on sectors and individual countries, then the property bubble and the deliberate bursting of that bubble, and then now into tariff wars and disputes. And even potentially seeing what happened with Russia, I'm sure a lot of investors are nervous about the similar thing happening if the relationship between the US and China were to sour. So I think for a lot of investors, it's uninvestable. I'm not going to go into a huge amount of detail given the time, but suffice it to say that once again, we like looking in uncrowded areas. So it's an area that we focused on and looked at. We did send a team there, I believe in early 2024, also to get boots on the ground and do the work. And ultimately, people focus on the fact that the Chinese economy is slowing. We've said it time and time again that the relationship between equity market performance and economic performance is not one-to-one. And actually what you tend to see is when countries go from a period of significant growth driven by massive capex and capital investment, when that growth starts to slow, that capital investment is no longer required and needs to look for another home. And that often results in equity markets actually doing well as the economies slow down to a more stable level. The other factors to look at is inflation's really low in China. Interest rates are low. The property market is not really a place that people are going to invest. And you've got fiscal and monetary policy that can be accommodative. So all of those actually potentially could cause a significant move within the equity markets. So we've got good exposure through Anta Sports, CK Hutchison, and Bud APAC.
Great. Okay, so great opportunities there. We have 1 minute to our 30 minutes. So I know we've got 2 questions online. Those questions will reach out to you, John, and we will specifically address those offline. But maybe if I can close off with a question from someone who preferred to remain anonymous. The 3M investment framework, you mentioned it earlier, has clearly done well for good recommended period and the outcomes over those recommended periods that clients would invest in. Is this investment framework still relevant for the future, or do you feel a need that there is a need to tweak it to keep up with what the future may bring?
Yeah, I think let me be very clear on that in terms of our philosophy and our 3M process, we have no intention of changing it. It's worked very, very well for our clients for a long period of time. And actually what's interesting is we've delivered with this philosophy and this process exceptional returns for clients, but it's actually been quite a tough environment. Our 3M process, the margin of safety means that we are correlated and tend to perform well when value does well. And it's been a tough time for value, but despite that, we've been able to deliver really good returns. We think with the rise of passive, globally, there's more than 50% of assets are now managed on a passive basis. We think with really, really very low tracking errors, people have forgotten the benefits of truly active, diversified, and differentiated asset management. That's what we do. That's our bread and butter, and we're going to continue to do that. We will always look to make improvements and tweak and improve the way that we implement it, but the base philosophy and process will remain unchanged. And we're looking forward to continuing to deliver exceptional returns for clients in the future, especially as some of those headwinds to our process actually turn to tailwinds.
Great, tried and tested, it works, and looking forward to continuing to deliver those great proposition for clients. So to the audience, thank you very much for joining us today. We hope you found this insightful. If I can just mention three things. So John mentioned Kevin Cousins' article that's coming up in the up-and-coming Angles and Perspective. It should be out in the next week or so. So please look out in your inboxes for that article. And then lastly, we're looking forward to seeing you in person in January when we kick off with our annual investment outlook. I'll be on the road with our head of equities, Justin Floor, and co-portfolio manager, Justin Floor. So a couple of months away, but time flies when you're having fun. So again, thank you very much for joining us today, and have a great day further. Bye-bye.
Thanks very much.